Single biggest mistake ag producers make when the RBA raises interest rates is waiting until their cash flow is tight to take action. Most people think that higher interest rates will send them broke. The truth is, it's poor cash flow management that kills a rural business, not the interest rate itself. After helping hundreds of producers secure over $1 billion in finance, I can tell you that the best operators don't panic when rates go up, they restructure. So in this video, I'm giving you the exact 4-step framework I use to see through the bank's tightening policies and find the loan structure that's actually going to protect your farm. The first thing you need to understand is that every single rate rise cuts directly into your net profit and cash flow surplus. On a substantial rural debt, even small changes can have a significant impact. Your borrowing capacity is reduced with every rate increase. With higher rates, loans are harder to get, and you need to make sure you're presenting a professional plan. Input costs are all rising, and often the largest cost is the interest rising. This means you need to be across your numbers. Forecasting is more important than ever. There is less fat in the system, so forecasting cash flow is absolutely critical. You have to know exactly where your break-even point is. I recently had a client with a $5 million facility. When rates were at 2%, their interest bill was $100,000 a year. Rates have now hit 6% and the bills jumped to $300,000 a year. That's an extra $200,000 a year that has to come straight out of the net profit. If they hadn't forecasted that increase and built a buffer into their cash flow, they would have been forced to sell off their core breeding stock just to make the interest payments. You have to run the numbers on a 2 or 3% increase before it happens and not after it. And the next point is, will the banks become more conservative? And that leads us to the next point. Banks get more conservative in a rising interest rate cycle. Lending policies tighten and there is more scrutiny on all aspects of the business. Funding approvals take longer and more questions get asked. You also have to consider the potential downward pressure on land prices over time, as there's fewer buyers and buyers can't access as much capital as before, and they need higher returns on their properties to justify the purchase. You have to be prepared for the bank to look at your application with a much more critical eye. They want to see that you have a plan for higher rates and not just hope that they'll go back down. When rates are low, banks are eager to lend, and when rates rise, their risk appetite shrinks dramatically. I've seen applications that have been approved in a week or 2 years ago, now taking months, with a bank demanding far more detailed cash flow projections. They're stress testing everything a lot more, and they want to see how the business performs if commodity prices drop at the same time as interest rates peak. If you can't show them that scenario, they'll simply just say no, and you have to present a bulletproof case. Just quickly, if you're tired of explaining your operation to a new bank manager every year, only to get a one-size-fits-all deal that doesn't fit your business, we can help. At Seasoned Finance, we do things differently. We've got over 70 years of combined experience in agricultural lending, and we work for you, not the banks. We're the consistent expert team in your corner, fighting to get the finance that actually helps you grow, purchase the next property, and build your legacy. Don't leave money on the table. If you're looking at your next move or just want a second opinion on your current setup, click the link in the show notes to book a confidential, no obligation chat with the team, and we'll show you what's possible. Righto guys, now back to the episode. The next point's around fixing or leaving your loans variable. Once you understand the bank's mindset, you have to look at the fixing versus variable rates. Farmers that locked in at low rates are winning now, but the fixed rates are currently a lot higher than the current variable rates. If you fix now, you're locking in rate rises today. Having a strategy around interest rates, a portion fixed and variable, works for people in tranches with different expiries. It's about managing the risk and not just guessing what the RBA will do next. You have to look at your own cash flow and decide how much certainty you need versus how much flexibility you want. I always tell my clients that fixing your rate is like buying insurance. You're paying a premium for certainty. If you have a massive debt load and a small cash flow buffer, you might need to fix a portion of your debt to guarantee you can make the payments, even if it costs you a little bit more in the short term. But if you have a strong cash flow and you want the flexibility to be able to pay down debt quickly or sell assets without a massive break fee, staying variable might be the better play. It's a strategic decision based on your specific risk profile and not a gamble on the market. Finally, don't wait until your cash flow is tight to take action. Look at refinancing to a better deal now. Consider interest-only terms and extend them before the principal payments commence. Interest rates are like predicting if it's going to rain or not. Plan for the variability and have a strategy to manage it. Higher interest rates won't send you broke, but poor cash flow management absolutely will. If you're proactive, you can restructure your debt to handle the higher rates without sacrificing your core business. The worst time to ask the bank for help is when you desperately need it. And if you wait until your account is overdrawn and you're missing payments, the banks hold all the cards. But if you approach them 6 months before you get tight with a clear plan and request to restructure your facilities to interest only or extend your loan term, you're in a position of strength. You're showing them that you're managing your business proactively. And that is the difference between surviving a high interest rate environment and being crushed by it. Remember, guys, don't let the RBA dictate your farm's future. Get your structure right, forecast your cash flow, and manage the risk. If you need help reviewing your current loan structure to make sure you have the flexibility that you need, reach out to Seasoned Finance and we can do the heavy lifting for you. Thanks, guys, and look forward to seeing you in the next episode. Thanks for tuning in to Dollars in the Dirt. If you've got value from today's episode, make sure to subscribe so you never miss the insights you need to grow your business. And if you're ready to stop being just another number to the banks, visit Seasoned Finance via the link in the show notes. Remember to follow us on socials and catch you next time.